Hello everyone, and thank you very much for joining our Grant Thornton Tax for Technology Companies webinar entitled Navigating Tax in a Digital World. My name is Louisa Dees and I work at Grant Thornton International. Before we start, I would just like to go over some housekeeping. All lines will be muted. Please ask your questions via the chat functionality. As you will just have heard, the webinar is being recorded, and for those of you attending, the slides will be sent out after the event. So, I'd like to start by introducing our three speakers for today. We have Steve Perkins, who is Grant Thornton's Global Leader for Technology, Media and Telecommunications. He is also the U.S. National Managing Director for their technology practice and is based out of Virginia. Steve's been working in the sector for more than 34 years now, although he obviously doesn't look it, he still looks very young, and has worked client and provider side. His primary focus is working with technology companies to develop and execute strategies for profitability and risk management. We then have Randy Free, who works at Grant Thornton in the US, based in California, specializing in international tax services. He has particular experience serving Asia-Pacific technology clients and has coordinated cross-border due diligence teams to manage income tax exposures and develop tax-efficient acquisition and integration plans. Finally, we have Alex. He advises clients on the indirect tax implications of their global footprint and international supply chain. His main focus is advising companies on entering new markets, launching new products or services, and providing commercial and scalable solutions to meet their global indirect tax compliance requirements. Alex works at Grant Thornton, UK. I will now hand over to Steve Perkins for our introduction.
Thank you, Louisa. And in full disclosure, I have to admit that it's now up to 38 years. So I consider all that to be valuable seasoning. So thank you for letting me join you today. And what I'd hope to do is just take a few minutes to discuss some of the trends that we see in the industry and set up our discussion for the rest of the webinar. About half of my 38 years I've been involved in advising technology companies, as Louisa indicated, on the effective use of technology, and about the other half of that as a senior executive inside technology companies, primarily platform and software companies. So I have certainly some sympathy for those who are trying to navigate these times. One of the things that I've really enjoyed about all my years with technology is just how quickly it changes. Other industries measure their innovation cycles in years. In technology, we measure them in months. And with some of the development approaches these days, particularly kind of in the internet consumer world, that may be in weeks. And if anything, that pace of acceleration is picking up. And I think that presents obviously opportunities for us and challenges for us as we think about how do we grow businesses in our domestic markets internationally. So let me just briefly mention a couple of things, a few of the transformations, a little bit about what that's doing to growth and how that's manifesting itself, and then just briefly what that means for our international perspective. So on the transformation side, I'll just highlight three of them. One is what's affectionately being called today the everything as a service. We hear it as SaaS or as a service, but it's really all computing platforms, applications, and infrastructures provided remotely. And I'd say, to use a U.S. baseball analogy, we're in the middle innings of that. The SaaS market, if we just think about the software side, is predicted to grow at a compound annual rate of 20% through the end of the decade. So there's still plenty of growth to go. As we know, customers are really demanding this as a service model to provide them with flexibility to acquire and leverage new technologies on a regular basis and really drive down their cost of computing. And it's requiring traditional technology companies particularly to adjust their operating models to build long-term relationships with customers, incentive structures that are tied to upsell, revenue and forecasting mixes, a whole variety of things. The next transition or transformation, I think, is even the biggest one to come, and that's really the Internet of Things or the Internet of Everything. We're in the very early stages there. And I believe the impact on business and society will be even broader. One estimate has the IoT by 2020 encompassing 20 to 30 billion connected devices. So literally permeating the world with computation capability. And, if we had to hazard a guess of how many of these new processors and computers will be connected, I think the answer is all of them. So a profoundly new world in which we'll all operate as technology providers, and people will operate as consumers of technology, either at a corporate level or at an individual consumer level. And those transformations are driving transformations and convergence in the tech industry. So we're really seeing the interlinking of computing and other technologies, information technologies, with media and telecommunications, fusing into single providers, single networks, single devices. And I think what we're seeing is just the tip of the iceberg. We're going to see kind of institutional activity and social life, business, government, art, journalism, education, all being transformed through this, this growing digital converged set of capabilities. The good news is this has been fueling growth for us in the industry. We're well into an almost decade-long bull market in technology, and I think it manifests itself in a couple of ways. One, we see the traditional technology companies, and I'm sure many of you are part of them. I certainly was. With lots of merger and acquisition activity to keep pace with these transformations. We've got the Dell EMC merger, $67 billion, the largest merger ever, on the docket. We just saw HP officially split into two businesses to better compete. We've got the Nokia takeover of Alcatel-Lucent. That's almost a $17 billion transition. We saw the eBay split out of PayPal after that acquisition taking place not too long ago. So lots and lots of activity between the more established players. We see the spawning of new companies all the time. While exits in the third quarter of 2015 were down a little bit, we still had 833 M&A and IPOs, really driven by internet, media, and hardware and services. So lots and lots of activity. And you're probably all reading about the unicorn phenomenon. There are, I think, globally the count is 141 private technology companies valued at $1 billion or greater. So tremendous growth. And as I mentioned, it's a global world. Almost from the outset, technology companies are global as they access customers outside their initial domestic market. They look for development and delivery talent around the globe. They establish support centers, and they optimize their tax position. So it's a rapidly transforming world, presenting great growth opportunities for us, increasingly international, but very, very complex. And I think we all need help in figuring out what's the right way for us to position ourselves for growth. So with that as a brief preamble, what I'd like to do is to just ask one polling question, if I could. I think it's up on your screen now. And this is on the international side. I'm curious whether you look at the growth plans for your company, recognize that many of you are already global. Is that a significant component of your future growth? And simply a yes or no, if you could just vote on your screen there, that would be terrific. And Luis, I think you're going to kind of add these up for us and tell us what the total looks like.
Yep, I'll just give it a few seconds while we
Okay.
create answers, and then I'll go to the results. So let me just skip to the results, Steve.
Mm-hmm.
There we go.
Okay. What's the answer?
So we have 92.3% of people saying yes, they have got international expansion as part of their future growth plans, and 7.7 saying no. So that's a great outcome for, well, certainly for this webinar.
Absolutely. So, well, that's terrific, and I think tees us up nicely for the rest of the discussion. So I think what I'll do now is hand it over to Randy Free, and Randy, you can take us from here.
All right, thanks, Steve. I'm going to spend a little bit of time talking about some recent developments in international taxation, specifically the OECD BEPS reports. We'll talk about R&D and innovation box incentives and transfer pricing as well before turning it over to Alex to discuss indirect taxation. So today's technology company looking to rapidly scale their operations is in a radically different environment than the dot-com era of just 20 years ago. There's existing new technologies that are available, allowing for new business models, and it allows for human resources, customers, and even financing capital to be more accessible than ever online, allowing for new ways of staffing and funding growth in the digital economy. At the same time, the international tax landscape cannot be more uncertain, largely due to the recent final reports published by the OECD containing recommendations for international tax reform. The OECD BEPS initiative is largely a political response to the growing perception, which continues to be hyped in the media, that the businesses are able to structure their operations with the use of artificial arrangements and tax loopholes, as President Obama would say, in such a way as to pay little or no tax, causing governments to lose substantial corporate tax revenue. The initiative currently involves governments of 44 countries, and the action plan identifies 15 key actions with the following areas of focus. Transfer pricing is front and center in the action plan. The action plans also address supply chain structures, financing structures, as well as intellectual property structures, which are particularly relevant to technology companies. So there's been so much information and talk around the BEPS project that the business community may have been numbed by all of this talk. But now is the time for action, and we want to make sure that this webinar can give you some practical steps to take to address the potential impact from the OECD BEPS project. So the high-growth technology companies expanding into the international markets should consider the impact from the OECD BEPS final reports. This means really understanding what those final reports say and understanding your own business so that you can understand that impact and identify areas where action may need to be taken. The reports were issued back in October 5th of 2015. And it was a comprehensive package of final reports that address each of the 15 action items under the BEPS project. And while this finalized action plan has some detail, there's a lot that is left to be done, a lot of very difficult areas still to be worked out, areas which will be initiated into legislation by local governments. The plan does have some standards. For example, the country-by-country reporting has some fairly detailed information about what would be required or what's recommended to be required by the OECD, as well as there's some detail in the dispute resolution process that's being recommended. But by and large, the remaining areas are much less prescriptive, and they're general recommendations to be interpreted and enacted ultimately by local legislatures. And we believe that this is going to cause, or at least provide the opportunity for a lot of divergence between how and when these recommendations are adopted. So as heads of tax, you really need to take this into consideration. The boards of companies need to recognize this point and bring tax in early to strategic planning decisions. Now, although there are aspects of the digital economy that exasperate BEPS, the OECD in its report under Action 1 addressing the tax challenges of the digital economy recognized that the digital economy was not separate from the rest of the economy and therefore should not be carved out for special treatment for tax purposes. So as we talk through the rest of the action items that are focused on the digital economy, we're going to draw from wider themes and recommendations from these other action items. So if we could go to the next slide, Louisa. There are three areas which focus in on technology companies in particular. Action 7 recommends changing the definition of permanent establishment to prevent the artificial avoidance of creating a taxable presence in a particular country. The recommendations significantly increase the likelihood that activities of groups, in particular technology companies with international operations, will now constitute a PE in another country where previously they did not. The OECD, for example, gave an example of an online provider of advertising services using a sales force of a local subsidiary to negotiate and effectively conclude sales with prospective clients. This might be a situation, for example, where the sales contracts are sent to an entity or group in another jurisdiction for final approval and acceptance, but in reality that acceptance is seen as more of a rubber stamp. The OECD is asserting that that sales force may now create a permanent establishment, whereas it has not in the past. They also gave an example of an online seller of tangible products who maintain a substantial operation in a local warehouse to facilitate the quick delivery of goods purchased online. I think this is fairly common where you need to have quick delivery, so you've set up warehousing in particular countries. The revenue from the online sales are booked in another jurisdiction, however, which is lower in tax and is the location of the regional headquarters. Up to now, most treaties allow for inventory to be held in country for delivery without creating a taxable presence. However, what the OECD is recommending would likely change this, such that the substantial operation, being the warehousing itself, could rise to the level of a permanent establishment. Action item 3, designing effective controlled foreign corporation rules. In looking at this, the OECD recognized that in designing CFC rules for controlled foreign corporations, consideration should be given to rules that target income typically earned in the digital economy, which are at present typically not subject to taxation. This income might be, for example, income from the remote sale of digital goods or the provision of digital services. The final recommendations focus on 6 key building blocks that the OECD consider are necessary for domestic controlled foreign corporation legislation to be effective. And when we talk about controlled foreign corporations, we're talking about subsidiaries of a parent in another jurisdiction that are effectively controlled by that parent company. The OECD are recommending looking at the definition of what constitutes a controlled foreign corporation, exemptions and threshold requirements for the CFCs, as well as definition of income earned by those CFCs, which would be subject to tax. We'll come back to transfer pricing in a little bit more detail later on. Louisa, if we could go to the next slide, please. We have a polling question. So if you take a look, do you think BEPS action plan will bring more clarity for your tax planning? If you'd use the screen to answer yes or no and submit your response.
Thank you very much, Randy. Just waiting for those responses to come in, and then we'll see what the results are.
All right.
Okay, so it's a straight 50-50 split.
50-50. Well, if I'm a betting man, I would bet on the side of less clarity, just given that there's so much detail here left to be worked out by the countries themselves. And we think timing of adoption of these measures, as well as the practical application of how they're incorporated into local law, may be very divergent between countries, so could bring a lot more controversy. So with that, we're going to turn to innovation incentives. While the OECD BEPS action plan generally will cause corporations to pay more in tax, there's at least one strategy for reducing tax that is endorsed by these reports. Recognizing that R&D activities create jobs and growth in IP-centric industries, the BEPS plan endorses a country's ability to provide tax incentives for research and development. But there's a catch and potential pitfalls for the unwary, which we'll discuss here. The OECD have put forth the following caveat to providing incentives. Under the theme of aligning taxation with the location of value creation, such R&D related tax incentives should only be granted under the principles agreed in the BEPS report. What this means is They are suggesting that substance be required to be located in their jurisdiction granting the incentive. Now, generally, there are two types of incentives that are in practice. There are innovation boxes and R&D credits. And you may ask, what's the difference? Well, the R&D credits provide a tax credit related to research and development expenditures, which are unrelated to the successful outcome of the activity. The innovation regimes, however, generally allow for a reduced rate of tax on income related to the innovation investment. So you can see that R&D credits are not contingent upon success, generally, while the innovation incentives are contingent upon success in earning income. So when you're considering research and development credits or innovation incentives, there are three things that you should focus on: location, the incentive itself, and the longevity. So location matters in terms of deciding where to place research and development within your supply chain. You may have quite a bit of flexibility. However, you may have already decided that you want to set up research and development in Europe, for example, and if you've headed down the path of setting that up in Germany versus France, your benefit could be X versus Y depending on the regimes in each country. So the placement of the function, because the OECD is recommending that function be required, is going to be very important to understand how that would fit into your supply chain and how it impacts the ultimate benefit. The incentives matter. As I pointed out, the difference between an R&D credit and an innovation incentive. The incentives differ by impact and requirements in order to qualify for the incentive. And so you need to consider what benefit is most helpful. Would you get more benefit or help out of a credit versus a reduced tax rate on portions of income? Longevity is also a factor, and what I mean by that is when you look at these incentives, some of them are very new and do not have much practical application as of yet. We've seen examples in our own practice where our clients have evaluated new incentives thinking that one benefit was available. However, when they worked through the practicality of how the local government would apply that incentive, the end result was much different than what was expected. Now, I mentioned pitfalls. Louisa, if we can go to the next slide. The pitfalls in the area of research and development and incentives regimes has to do with the taxation of income. As I mentioned, the OECD recommended the alignment of substance with the granting of these incentives, and this can cause an unforeseen tax cost. So let me explain that. This diagram depicts relationships between local incentives, local taxation, and operational substance. Now, the OECD BEPS initiative in looking to increase tax revenue for countries is all about aligning operational substance with taxation. The R&D incentives, on the other hand, are focused on aligning the R&D incentive with operational substance. So according to the recommendation by the OECD, companies wishing to avail themselves of an innovation incentive should place this operational substance, the R&D activity, in a particular country. Well, that very substance, that activity, attracts a certain amount of taxable income or profit to it through normal transfer pricing mechanisms. And if the taxable income, which ultimately qualifies for the incentive, is only a small portion of the total taxable income, the company will effectively have subjected a larger portion of its taxable income to full rates and may be in a worse tax position overall. So what this means is when you evaluate the incentive regimes, typically it's only a portion of revenue related to a particular exploitation of an intangible that qualifies. So when you're looking at total revenue, only a portion may qualify for the lower rate under the incentive, while the totality of income, then the remainder, I should say, would be subject to the higher rates. So you want to be careful you're not attracting more income into a higher rate jurisdiction in order to qualify a smaller portion of your revenue for an incentive. So let's move on to transfer pricing. If we could go to the next slide. The OECD has recommended or recognized the importance of intangibles in the digital economy, emphasizing that entities should earn in economic returns based on the value that they create. Let's go to the next slide, Louisa. So they're looking at the value created through functions performed, assets used, and risks borne in the development, enhancement, maintenance, and protection of intangibles. Legal ownership alone will not determine entitlement to a reward. And so that's the main point that they're making through transfer pricing. So I'll say that again, is that legal title or legal ownership alone will no longer be determinative in terms of entitlement to profits. So contractual allocation or risk or ownership may no longer suffice. The framework for analyzing intangible transaction involves several steps. You would first need to identify the intangibles, which is somewhat complicated in the digital economy. For example, when you look at data analytics, is data itself an intangible, or is the process of gathering the data and processing the data, is that perhaps an intangible, or the software around that? There's many types of intangibles that have not here to now been available or created through regular economy that are now being generated by the digital economy. So the identification of the intangible itself can be challenging. You have to look at then the contractual arrangements with the emphasis on legal ownership as a starting point, followed by an understanding of how the performance of functions may impact risk and the ownership of intangibles. Finally, you would want to review the legal contracts against the functions of the group to see if there's alignment. Where the actual conduct of the entities differs from the contractual arrangements, the conduct or the functions will prevail, and the actual transaction will be deduced from those facts. So let's go to the next slide under transfer pricing. We've mentioned the word substance quite a lot. It plays a key role in the OECD BEPS initiative. Again, I mentioned they're looking at aligning the performance of functions or substance with the location of taxation. So this is a shifting of the evaluation of tax liability from risk and ownership of assets, moving to more of a people and a function evaluation. You're also moving from a focus of transfer pricing at the transaction level to the enterprise-wide level, meaning you would need to give consideration to profit allocation across the entire supply chain and not look at just the profit earned in a particular country. So again, the tax head needs to be at the forefront of strategic decision making, and this will likely require different skills for the head of tax, stronger engagement with the business, and a stronger understanding of its markets and its commercial priorities. So let's turn now to practical applications as I wrap up. If we can go 2 slides forward. While the impact, one more slide, Louisa, and we'll focus on the impact of BEPS recommendations varying from business to business. The way you manage tax and your role within the business will change quite significantly. You need to be able to demonstrate substance. Again, that word substance, and that means aligning the tax paid with the location of the value creation, understanding where people, functions, intellectual property ownership, and risk-bearing capacity are present in the supply chain and how that is aligned with the profit and taxation. As I mentioned, it will shift the evaluation of tax liability from risk and assets to people and functions. Let's go forward to our last slide in my section. In terms of the practical application, so what to do now, you really need to step back and look at your supply chain as a whole and go through what I refer to as a 6-step risk analysis. And looking at each entity in the supply chain, you first need to identify risk within the supply chain. And this could be internal risk or external risk or a combination of both. The second step would be contractual assumption of risk. So now that you've identified the risk, you would look at your contracts between the related parties to determine how risk is allocated contractually. Third, you would look at the functionality within the supply chain and how risk is evidenced by the functions being performed. The fourth step would be to determine if there is an alignment between the contractual allocation of risk and the risk evident by the functions within the supply chain, and where those misalignments might occur. If there are misalignments, that may mean that you need to look at moving people or functions within the supply chain to minimize the gaps. And that would be a realignment or reallocation of the risk as the fifth step. And then the final step would be pricing that transaction as is evidence between the alignment of the contractual allocation of risk with the functions performed within the group. Louisa, with that, I'm going to turn it over to Alex Baulf, who will lead the discussion on indirect taxation. Thank you.
Thank you, Randy. Hello, everyone. We've just got a quick polling question now. So, based on what you've just heard about, the changing face of tax and all the initiatives of the OECD, are you worried about the increased burden of tax compliance? Yes or no? Just wait a couple more moments as those votes come in. Well, not surprisingly, the results are changing right in front of me. I think we're about 2/3 yes, 1/3 no. Yep, right on the nose. So yeah, a good split. Well, hello everyone. Just by way of quick introduction, I'm Alex Baulf, an Associate Director with Grant Thornton in London, but I also work extensively with the US and across the globe with many technology and digital sector clients, from Fortune 500 companies to startups that scale up very quickly, and of course, the true disruptors in the digital economy. So Randy mentioned BEPS and the recent report on the various actions. Action number one on the digital economy, although, as Randy correctly said, there was no kind of direct new rules, new tax in relation to the digital sector, what that action one did say, it really put an emphasis on consumption taxes, the importance of levying VAT or GST on cross-border transactions, and the idea that OECD nations should follow the international VAT GST guidelines. And in fact, these were ratified in Paris just last month. And also, it was also discussed that countries, if they don't already have one, to introduce a concept of the reverse charge. So this ensures there's a level playing field, and even though a non-resident supplier may not need to charge a business VAT because they're not in the same country, that customer will have to self-assess for VAT, so a bit like use tax in the US, and therefore if you're an exempt business, like in the financial services sector, VAT becomes a cost and you're in the same position as if you bought those services from a vendor next door to you. So very quickly, just going over the basics of VAT and GST, as I know there are a number of US-based businesses on the line. VAT is a consumption tax, it's an indirect tax. It's borne by the end consumer, but it is charged and collected by businesses. It's a multi-stage transaction-based tax levied at every single stage of the supply chain, and that includes the digital supply chain. It's a credit method tax, which means for businesses, if they incur that tax for a business purpose and they're using the goods or services they procure to make an onward taxable supply, they can generally recover that tax. And there's a very wide scope covering goods and services, and in a minute we're going to look at the definition of goods and services and how that applies for tech companies in the digital sector. So just as a global trend, VAT GST systems are spreading. From first being introduced by the French in the 1950s, we now have over 150 countries globally with a federal level VAT or GST system. And on top of that, many of these countries also have dual state and municipal level taxes. So for any European-based businesses on the line, be grateful that you have a federal level indirect tax and nothing at a lower level. In the US, there's actually around 10,000 different tax jurisdictions because state and local taxes can be charged at a state level, county level, municipal level, to that very granular detail. And really, there's a VAT GST in every major economy outside of the US. So the Bahamas, I think, is quite indicative of this trend, often seen as a bit of a tax haven. Even that country introduced VAT in January this year. Malaysia introduced GST. The terms are really interchangeable. Where we say GST, read VAT, and VAT GST. That replaced the local service tax. In the Gulf states, so for example the UAE and Saudi Arabia, there are draft proposals on the table to introduce VAT to plug the fiscal deficit caused by plunging oil prices. And in India, a country where there's often been a number of taxes, different levels, state and municipal, different ones on goods and services. The idea is this is going to be brought together as a single federal GST. Watch this space. We were told it was going to be possibly April next year. I think the Grant Thornton view is possibly April 2017 now. And as well as new VAT regimes, we're also seeing rates rise. So while globally most income tax levels have come down, indirect tax rates have shot up. The average rate in the EU and Latin America is currently around 20%, but again, the trend is that's rising. So again, a bit of background. In terms of business-to-business transactions, VAT GST is a very transparent tax. It's added to the agreed price, and it's clearly shown on an invoice that's issued to the customer. This has to meet various invoicing requirements, and it's important to note that these requirements do differ from country to country, although in Europe, with the recent invoicing directive in January 2013, a lot of those rules are now harmonized. And one of the reasons why we have this transparency is that most businesses, as I said before, are able to recover that tax. They're able to take a credit. And therefore, that VAT needs to be clearly shown, and so they have the evidence to recover that tax. B2C, so to private consumers, on the flip side, the VAT is generally invisible. It's baked into the price. Very different from if you go to the US and walk into a store and sales tax is actually added at checkout. So this, again, leads to some commercial decisions around pricing. If VAT is due on a sale, do you keep a consistent price and your margin is affected based on the rate? Or do you, based on the VAT rate, change your price based on the market that you operate? So I said before that there's a very wide scope in terms of the taxable base for VAT GST. Goods in the EU legislation is described as the transfer of the right to dispose of tangible property as owner. And VAT is due when these goods are made available. So even though an export of goods may be zero rated or exempt, there's still a requirement to provide full supporting evidence to show why tax hasn't been charged. VAT is also due on the movement of own goods. So if you're moving goods as part of the supply chain, maybe to a warehouse, to an inventory in another country, that could lead to requirements to register and account for tax. And when goods cross borders, it's generally the importer of record that's responsible for paying that VAT. So if you're shipping tangible goods to support technology, across borders, it's always good if your customer is the importer of record, because generally any VAT or GST that's payable on the border is payable by your customer. And anything not within that definition is actually a supply of services. So, VAT is a very broad definition, and we're not having the big debate that you have in the US at the moment, where sales tax focuses on tangible personal property, and we're seeing many states and even cities, so the city of Chicago, try and broaden the definition of what tangible personal property is, and increase that tax base. So digital services have actually been covered in European VAT legislation since 2003. So in the legislation, in the Directive on Electronically Supplied Services, this covers at a very high level supplies of websites, web hosting, the supply of software and updates, images, texts, information, databases, music, films, and games. And really that's if it's cloud hosted, downloaded, streamed, anything that's provided electronically in an automated fashion without human intervention. So as I said, the legislation has been in place since July 2003. This was aimed at non-EU vendors, so mainly to ensure that tax was charged from US vendors. And the place of supply where tax is due is actually where the customer resides, so the customer location. And since 2003, there's been the option to streamline compliance, formerly known as VOS, VAS on e-Services, or the one-stop shop. This has been replaced from January this year as the mini one-stop shop. You can remit tax across the 28 EU member states through one mini one-stop shop or MOS return. In the EU, we now have a complete level playing field. We play by the same rules as non-EU businesses. Prior to January this year, the rules were you charge VAT based on your location as vendor. So it wasn't a surprise that a lot of the larger digital service providers based themselves in Luxembourg, where the VAT rate was 15, or in fact as low as I think around 3% for certain digital supplies. But from the 1st of January this year, we're on a level playing field, and VAT is due where that customer resides, and there's also the ability to use this mini one-stop registration to remit tax across the EU. So we've talked about B2B and B2C, so how do we distinguish between the two? VAT number is key evidence. It's evidence that the customer is in business, but it's also evidence that the customer is able to self-assess for tax. So while that B2C legislation that we just looked upon forces the vendor to actually charge tax to a consumer, if you're not based in the same country as a business customer, that business customer can actually self-account for the tax themselves, like a use tax in the US. So it's best practice to obtain that VAT number, validate it. There are multiple services available online to see if that VAT number is true. Those are often run by the tax authorities themselves, so that there's the VISE VAT online service from the European Commission. If your customer says they have a VAT number pending, they're waiting for it to be issued, you may be able to still treat them as a taxable person, a business customer, and obtain some further evidence. But conversely, if you don't have the evidence, so someone doesn't provide you with a VAT number, you're actually well within your rights to treat it as B2C and charge tax. And this brings us upon some of the challenges of the digital economy from a VAT GST point of view. Because the legislation says VAT is due on the place where that person's established, has its permanent address, or usually resides. But by definition, a lot of these digital services that we're providing are essentially anonymous services. They can be low value, high volume transactions. There's not always an ongoing relationship between the supplier and customer. And often, you as the supplier are distanced from the customer by intermediaries, by marketplaces, app stores. And so to respond to this, the European Commission agreed implementing regulations which introduced the concepts of rebuttable presumptions. Interestingly, this is the same kind of language that's been used in the US when we're looking at Nexus. So what are these presumptions? Well, the presumptions are that for your safe harbor to identify the customer location, if you can obtain 2 pieces of non-contradictory evidence, you can charge VAT based on that location. So what are the examples? That could be the billing address, it could be the IP address of the customer, or you could use other geolocation software. The bank details, maybe the BIN number from a credit card, the mobile country code on a SIM card, or any other commercially relevant information that you might be able to obtain. So if you can obtain 2 of those items, your home safe and dry, you can charge VAT based on that location. But, and this is only in cases of abuse or misuse, a tax authority can insist if they have 3 pieces of non-contradictory evidence that you use that alternative country address. But I think it's important to note that this is just the EU. We're seeing more and more countries introduce rules to tax digital services, and therefore, there may be instances where this tax policy goes against the location rules from another. What are the added complexities? Well, it's possible that based on BEPS and the key actions that Randy just discussed, that we may have new concepts of PE. Could it be that servers, outsourced infrastructure for cloud-hosted supplies, digital services, that could possibly be considered as an establishment for VAT purposes, not just in the EU, but in the 150 countries that have a VAT GST system. There's obviously complexities around using an agent, and we often see that agents will take on different roles in different countries based on the local VAT rules. And there's often a concept of use and enjoyment, where these digital services are effectively used and enjoyed, and that can override the normal tax rules. So I said this was a growing trend. So the EU, the 28 member states that make up the European Union, have rules in place. But we're seeing this expand across the globe at a very heavy pace. So in Europe, Switzerland, Norway, Iceland, and Albania, they've all introduced similar legislation to, in effect, mirror the EU position. South Africa last year introduced rules to tax digital services. Interestingly, that also includes business-to-business transactions. So, if you're providing digital services to customers in South Africa, even business customers, there may be a requirement to register there. And then across in the Asia-Pacific region, Japan from 1st of October this year, Korea from the 1st of July, and Australia has announced plans to introduce what it calls a Netflix tax in July 2017. And just in the last 2 weeks, New Zealand, Australia's neighbour, has said it's going to introduce the same. But they're going to introduce that from, I believe, July 2016. And this really is going to become the new norm. Not only was it mentioned in BEPS Action Point 1, but again, it was ratified in the VAT GST guidelines in Paris just 2 weeks ago. Some other key considerations, this isn't just in terms of the digital services that are provided, but in any technology supply chain. Look at intercompany charges. These still need to be documented. There still may need to be a requirement to charge tax, self-assess tax, provide proper supporting tax invoices to support transactions. And then, as I said before, whenever you've got agents involved, that can provide a lot of complexities within VAT GST, the role they're playing, and what amounts you account for the VAT on and at what time. If you are supplying a mixture of goods and services, and digital content and non-digital content, that could possibly lead to bundled supplies leading to an apportionment, where tax could be due in multiple countries. And then if you are importing goods into countries, you really need clarity on who the importer of record is. If that's going to be you need to look at the classification and valuation of those goods, not only for VAT and GST at the border, but also for customs duty. And of course, customs duty is generally a genuine cost because it can't be recovered. So what are my high-level conclusions from a international indirect tax point of view? Well, if you're providing digital services, if you're fulfilling goods in a country that has a VAT GST system, VAT is likely to be due on global sales. If it's B2B and the customer is not in your country, obtain and quote, validate the VAT GST number. That customer is likely to be able to self-account for the VAT due. If your customer base is B2C, that may require a local registration, but there are streamlined registrations available across the EU. And that this legislation is evolving. We're seeing it in more and more jurisdictions. And some of these rules can be quite subjective. As well as VAT, there could be withholding tax. So that's often the tax of choice in Latin America. There are wider commercial considerations. How does this impact on your pricing policy? And there's also quite major data implications in terms of customer, supplier master data that you need, the transactional data that you need to retain, not only for a tax determination decision, but for audit trail and for audit defense. Right, and that's everything from me on the international indirect tax side. I'm now going to pass back over across the pond to my colleague and head of technology for Grant Thornton, Steve.
Thank you, Alex, and thank you, Randy. A terrific summary. And I thought I had a bit of perspective on what's going on in international tax for technology companies, and now I'm appropriately anxious. So it's clear to me, just as a brief wrap up here, that the playing field is changing rapidly. We talked about the very nature of the digital goods and convergence doing it. It's clear around BEPS and GST that the landscape is changing as well, and that there'll be continued uncertainty, and that's going to take place, under the lens of growing political pressure. And lots of pending discussions, on local or decisions to be made on local government level. The rules are going to change around the definitions around functions and legal title and substance, incentives, longevity, a whole variety of things that you heard Alex and Randy discuss. And also that, the role of head of tax for technology companies is going to even become a more strategic partner with the business as they think about international expansion and how best to position the business. So thank you very much for joining us and for Randy and Alex for providing your perspective. Luis, I think there might be time for just a question or two. At the end, I'll turn it back to you.
Yeah, so I think in the interest of keeping to time, we will have one quick question and then the rest we can answer following the call. So this one's actually directed to Randy, and it's how quickly is it anticipated that the OECD BEPS recommendations will be adopted into the legislation by the various governments?
Thanks,
Randy?
Louisa. Thank you. We're seeing a few countries sort of race ahead, if you will, to start to enact legislation, but by and large, we think this is going to take time. It may take 2, maybe even 3 years in order for local countries to work their way through the adoption of these recommendations. That doesn't mean companies should wait, because certainly if you're considering that you may need to move functions and people, those things take time and are not easy to do. So take a look now to make sure that you're in alignment with those potential impacts, but it could take 2 to 3 years to work its way through.
That's great. Thank you very much, Randy. So at this juncture, I would just like to thank everybody very, very much for their attendance and draw your attention to another couple of webinars that we have in the calendar. So we have on Thursday the 3rd, so the day after tomorrow at 3:30 GMT, Grant Thornton UK is holding a cybercrime webinar. And on Wednesday the 9th of December, across the pond, the US firm is holding a cybersecurity in the cloud webinar. So please feel free to register for whichever of those would be most appropriate for you. So thank you very much for your attendance. A full copy of the slides will be issued out to you first thing tomorrow morning, and a recording will also be available for those interested. Thanks for your time, and we look forward to seeing you on the next Grant Thornton webinar. Thank you very much.